Hello everyone and a very warm welcome to today's stock markets update for Saturday, April the 5th, 2025. This is going to be a long webcast. We're going to cover a lot of charts. We're going to go over the daily charts, the weekly, the monthly, and especially focus on the big picture, as well as show you some very extreme readings that history shows tell that we are much closer to a bottom than to a top, but not necessarily the bottom. But remember, B stands for bear market, bottom, buying, as well as bimbo. What does bimbo stands for? A bear market is a major buying opportunity. These are all the bear markets in history since the 1920s. We can go all the way back to the 1800s. And every single time it was a fantastic buying opportunity. The world's not going to end. The sky is not falling. Please have a long-term view. Please zoom out and realize where we are in the bigger picture. If this is indeed the end of the stock market, it's going to go to zero. Trust me, the Western civilization as we know it is over. You will have no use of your money or anything you have anyway. And we can relegate ourselves to the ancient civilizations like the Greeks, the Romans, the Mayans, etc. I really mean it, because the stock market drives pretty much everything because it's the economic barometer. Now, it doesn't like what it's seeing with the tariffs. That's fine. I might have a little bit of a different opinion. When I see that China most likely charges 70% on US goods, and we now charge them 35% on Chinese goods, I think that's a fair deal. If Europe apparently, and I'm not an expert on tariffs, but that's what I've seen so far, charges 30-40% on your goods, then us charging 20% on their goods seems still to be a very fair deal. But I don't really care too much about the why. This is, of course, topics for cocktail parties. This is the long-term chart. And if you can zoom out and have a long-term view, then you can really see bimbo. A bear market is a major buying opportunity. Question is, have we bottomed? Now, don't worry about not nailing the bottom. If you have a long-term view, you don't really care too much about the bottom. Zoom out, all right? That's really my message. Because these are the bear market's returns of frequencies we see. Currently, the S&P 500 is down 16 to 20%. That happens about every fifth year. So far, nothing out of the ordinary. If we go down 20 to 30%, we see that happens about every 15 years. Still frequently occurring. So in that sense, we're getting very close to a historical opportunity for most of us, which is fantastic. So please do not succumb to the bearish sentiment du jour, but keep a big picture view, as we think we are currently either in this fourth wave, potentially an A wave, potentially a C wave, depending which index. The C wave for the IWM, most likely, the A wave for the semiconductors, the fourth wave for the S&P 500, and once again, the A wave, the technology sector. So every index is doing a little bit different. So let's go and assess the price charts. I'm going to start off with the S&P 500 daily chart. On Thursday, it still had the chance to do this A, B, C for a irregular expanded flat B wave. Remember that one? I already deleted it from the chart, but this was then alternative B, and then we would get alternative C and then lower. We continuously focused on the 5120 plus or minus 20 zone as inevitable. That's what I told you in Wednesday's webcast. That's what I shared once again on Thursday. And here we are. We now have a extended wave on our hands. Typically, the third wave targets somewhere around 5200, 5250. I cannot predict the future. I do not have a crystal ball. So we have, unfortunately, a wave extension on our hands that should target somewhere around 4,900 to 5,000. We'll bounce back to probably about 5,200, 5,250, potentially as high as 5,400, and then ideally a final decline into the 4,800, 4,700 zone. That is a wave extension that can happen. And so far, please remember, the only time I've seen 5 waves lower are either A waves or most often large C waves. Like the COVID crash was 5 waves lower, a C wave. The 2016 final low was 5 waves lower, C wave. The final low in 2009, 5 waves C wave. 2011 was a irregular, expanded, flat, 5 waves lower C wave. It's never a third wave. I've never seen a third wave lower in my lifetime, nor when I assess the price charts on a historical basis when I was not involved in the stock markets. Okay, so this is what we're currently looking for. Can this still be a red wave 4? Well, it's going to start to get a little bit dicey. Allow me to explain. And that does not mean the top is in. Allow me to explain. First and foremost, Xenia Tobina from XT Financial Services is also looking here for a wrapping up of a 34345, potentially all of 3, all of 4, all of 5, into this target zone somewhere between 5,000 and 4,800. Somewhere between 5,000 and 4,800. That's exactly what we're seeing as well. Definitely deeper than anticipated. All right, we had 51, I believe 51.16 as the ideal downside target. Well, we definitely went a little bit below it at 50.74. Okay, still not completely crazy miss. It just got there a lot faster than anticipated. Again, it's not the end of the world. So let's start off with what we originally were tracking, which is still actually technically feasible. But if we start to move lower into the 4800s, we probably have to align the wave chart better. And it still means we can still go much higher. Okay? Yes, I remain still bullish. The final warning level is below 3,500, which is pretty much the October-November 2022 low. All right. If we go below 4,800, that would be also a serious warning. It's the 50% extension. We're still in a long-term uptrend, and we've so far just peaked within this long-term uptrend. Okay. So this wave 4, this is our assumption of a standard Fibonacci-based impulse pattern. All right. Starts to fall apart. The third wave tends to top here at 100% to 123.6. It did that exactly. We said we're then going to bounce to about 5,800, 6,000. I think we got 57.84. So far, so good. And then we're going to go down to 51.16. So far, reasonably okay. We're at 50.74. So it can still be a fourth wave. Okay. It is still very possible that simply went a little bit deeper than anticipated. It is possible, but it's not my favorite anymore, and we really have to see a quick reversal. But as the daily chart points out, that might not happen until, honestly, May 1st, and I'll show you why. Not yet. So this is started to become a little bit less likely. The standard Fibonacci-based impulse pattern is getting a little bit less likely. Now, this means that from the October 2022 low, we actually only have 3 waves up. Okay, so this could be part of a massive, larger ending diagonal. We have wave A here. So this is 3 waves up. 1, 2, 3, 4, 5. Okay, this is then an A wave there. Because we have, and then we have 1, 2, 3, 4, 5. So that is then wave C of wave A. So then wave 1, wave 2, and this is becoming a massive, large ending diagonal primary 5 wave, targeting ideally 7,755. The ideal bottom here will be at 4,800. Okay, 4,800 is kind of what we're looking for here as well. If we take a Xenia Tobina's wave count, all right, 4,800 is also what we're looking here. If we take a extended Fibonacci-based impulse pattern, also late April, early May. Yeah, this is starting to look good. I like it. May 1st is where we will tag this trend line. And then if you can see here, if we get a nice extension, almost C equals A, but in this case, C will be 0.764 times A, targets the 123.6% extension right there at 6,738 later this year, into the fall of this year. Yes, this could be a massive rally. And I'll show you that in a moment. We can have a V-shaped recovery. All right. It doesn't have to be here. We can also go to the 138.2 somewhere in 2026. But this is what I show you here, a standard Fibonacci-based leading diagonal or ending diagonal pattern. Just as we were tracking for the rally that started in August last year, which was also a ending diagonal. Remember this path? This was a ending diagonal. So we could now see it on pretty much a much larger scale develop. So all hope is not lost. All right. look at the technical indicators, they're really getting into bottoming zones. We're almost as oversold as in 2020, almost as oversold as 2022. These are conditions, not trade triggers, but every single time that happens, we get very good returns. So this would then be wave 1, wave 2, wave A of 3, wave B of 3, wave C of 3, wave 4, and wave 5. All right, so this is still very possible. The alternative is that we are one step ahead and we just stopped for a larger third wave and we are now in this fourth wave. All right. If we go below 4,800, it really increases the odds we're getting wrong. And then we have a final fifth wave to the 6,700, 7,100. Now, again, I still can only count 3 waves up from the 2020 low. All right. Unless this is something else. This whole 2018, 2020, but this is 3 down, 3 up, 5 down. It must be a flat. The rally here from 2019 or 2018 it is, this rally was 3 waves. I remember back then I was looking for a wave 4 and then a wave 5. It did not happen. The A wave was then wave 1, the B wave was wave 2, this larger B wave was wave 3, and we were looking for a 4 and 5. It didn't happen. So it broke below key levels, and that's when we knew, all right, we are in this larger C wave of a primary fourth. All right, A, B, C for A, B, C for B, 1, 2, 3, 4, 5 for C of 4. So that completes primary 4. Then we must get 5 waves up from this low. And we have not seen 5 waves up, unless there's been a squiggle fourth wave here in a few weeks, whereas all of wave 2 took a year? I don't think so. But again, even the greats can be wrong. Remember, even the great. If I'm a great, I can be wrong too. This was the video by Larry Williams that I shared with you. And when he speaks, you listen. He is great. It's rally time. Well, obviously he was wrong. I'm not saying he's a bad analyst. There's just no market gurus. We all get it wrong once in a while. All right? That's okay. This is an interview here with David Hunter. Also, he is a great, and he was very bullish as well. And he was looking, I believe, for a parabolic advance in stocks. Well, it went parabolic the other way. It's okay. We all get it wrong once in a while. All right? These are our insights and analysis we do, and sometimes we get it wrong. If we see the market top at a standard Fibonacci-based impulse pattern for a third wave, that is what we choose. And if the market then proves us wrong, and we're wrong to prove them right, then it is something else. So here is a larger fourth wave option and still a larger fifth wave option. It's very possible, okay, that this is materializing. And then a wave, and that's it, compared to 2 more waves, and that's it. All right, see the difference. But both of them are still looking higher. This matches with what Avery is seeing at ATM Snipes. He thinks we've completed a larger third wave. It's odd because 3 equals 1, but it's okay. That's what it is. Then we also know that 5 has a limit because the third wave cannot be the shortest wave. And that we're now in this protracted C wave back to about current levels. All right. This is a fractal from 2011, which is following. Fractals are great till they don't work anymore. All right, that's the problem. It's a good roadmap. And again, not saying he's wrong, but this is a very doable path. Though I believe we might actually bottom May 1st already. All right, that would be all of the fourth wave. Wouldn't surprise me. If not, we'll probably bottom then in the fall, and then we're going to rally. All good. Again, this is then our alternative. The B wave, right, is underway. Well, the C wave of the B wave is underway. And then, of course, we're going to get our large C wave. I'm just following here trend lines. We don't necessarily have to follow those trend lines, all right? But it would look really nice if we start tagging them. That's pretty much a very good way to resolve this issue of this very rapid decline, which really feels like a C wave, all right? C waves are 5 waves, just like the COVID crash was a C wave, 5 waves. So we're now going to complete the third wave of the C wave. We're going to see a fourth wave and then a final fifth wave. Moving on to the Nasdaq 100. This one can have put in its cycle 3 top. All right. So far, we've seen a bearish reversal back below long-term bullish uptrend line we broke above in 2023-24. Okay, so this one can be doing something else. There. We broke above it and now we're below it. That's a bearish reversal. 2022 was primary 4 because primary 1 and primary 2 and primary 4 are equal in length. Back then, we bottomed just a little bit shy of the 38.2% retrace, or actually a little bit below it. So if we're now in cycle 4, we should expect it to also do the same. So somewhere between, I would say, 14,000 and 11,500. Fourth waves are very complex. You see here this C wave, cycle 2 wave, I mean. That's a simple zigzag, all right? Very simple. This is akin to the 1920s crash, early 1930s crash on the Dow Jones, and this was a similar pattern, all right? That's a zigzag. So then the fourth wave will likely become a flat. So I think we're going to bottom out pretty soon for wave A. We're going to get a massive bounce back for wave B, which can challenge the all-time highs, and then a wave C. All right. So cycle 2 here lasted for about 3 years. So this cycle 2 can also last for about 3 years, getting us into the late 2026s, somewhere around there. I have it here, of course, on the chart, but that's because I just want to work with the space available so you understand my thinking. So this is the big picture possibility for the Nasdaq 100. And remember, this is not the S&P 500. Just the mere fact that we had a primary 2 here, 2008, 2009, and this was not a primary 2 for the S&P 500 or the Dow Jones. Because in 2009, the Dow Jones and the S&P 500 went below their 2002 lows. The Nasdaq and Nasdaq 100 did not. Okay? Entirely different wave count. So, where does it leave us? Wave 3 is underway. So far, nothing out of the ordinary. I think on Thursday I said we're going to go to about the mid 17,500s on the Nasdaq 100. We're right about there. So wave 3 ideally 17,275. Wave 4 back to about 18,200 plus or minus 200. And then wave 5 down to the 16,400, 16,800. All right, 16,400, 16,800, which brings us back here to this 2023 high, somewhere around there. Dow Jones, similarly extending. The 1-2, and we had the Alt B wave here, right? Remember the A, the B, and then this would be B and then C, is off the table. So we can, of course, get rid of that little target zone. We definitely fell below it on Friday. So that was the cue. That's not going to happen. So now we're extending. And extensions are always a little tricky because we don't know exactly where the next bottom will be. Is it at 238.2? Is it at 261.8.2? Is it at 223.6? We don't really know just yet. So, but we think this should be something we're going to look for. All right. These are now our extended wave targets, which are a little bit less certain because we just don't know yet exactly which ones it will take. So we are extending, so we expect a little bit lower prices and then here. Okay, so the warning levels for the bears can be adjusted as well. The first warning level is, of course, Friday's open. The second warning level is first day's close. The fourth warning level is the first wave. And then the second warning level is, of course, the second wave. All right. So we're now in this extended wave. And yes, we can already rally on Monday. So this is really just a general path of a extended wave higher. And unfortunately, extensions are hard to forecast because we, as said, don't know if it's going to be 261.8 or 238.2. So here we have a adjusted wave count. Again, I cannot count 5 waves up from the 2020 low. The 2020 low, in my humble opinion, unless I'm completely wrong, was primary 4. You can clearly see 3 waves up, and this was 5 waves lower. All right. This was absolutely 5 waves lower, and that was a wonderful, fantastic impulse path lower. This is the 2020 COVID crash. Wave 1, wave 2, wave 3 at 123.6, wave 4, 76.4, and then an ending diagonal, wave 5. So we're about to wrap up this third wave, all right? And we're now in this fourth wave, should take a couple of days, and then you can see the fifth wave, 1, 2, 3, 4, 5, 6. About 2 trading weeks, plus another week and a half, gets us very close to the end of April. Why is that important? The end of April, beginning of May, will give us, there you have it, fantastic confluence of the trend line. So we have this top here, this top here. We draw a parallel line, and then we can still do this ending diagonal. All right. Again, I can still only count 3 waves up from the 2020 low, wave 1, wave 2, and I still can only count 3 waves up here as well. Can this be 3 and 4? Absolutely. And then this is 5? Sure. Then would that be 3 and then 4 and a 5? I prefer to count it as an ABC if this is a ending diagonal. Now, we can align this with work done by Colin Talks Crypto. He's on X, and he's found a fantastic relationship between global money supply, M2, offset by 108 days, for Bitcoin and S&P 500. It looks like we have a temporary bottom in place soon, somewhere around April 6th, which is Monday, and then a final bottom due Thursday, May the 1st. May 1st. It hits it on the spot, all right? And then a lot of global liquidity is coming back. It's going to rally. Global liquidity is going to rally May, June, July, and it can't look further forward than that. And you can see here we have a very good relationship between global money supply, Bitcoin, and the S&P 500. I believe the correlation is somewhere around 82.5%, which is fantastic. 60% of the time, it works every time. But there are more variables than just money supply that, of course, drive markets. One of them is, of course, politics. Of course, important. Global events, they're also important. But liquidity drives markets. How much is there and how much does we want to put to work? And as you can clearly see, there hasn't been a lot since the beginning of this year. There's going to be a lot more into the summer. Remember also the Federal Reserve is going to taper off its quantitative tightening. So that means we're going to squeeze less and less out of the system. So there will be, in that sense, of course, a little bit more available. And that starts to show up potentially in this global money supply. This is offset by 108 days, by the way. It takes time for global money to work its way into financial assets, of course. It has to go into paychecks. It has to go into savings accounts, you name it. But this is fantastic. So it looks like, again, we have potentially a local bottom in place soon. And then we're going to flubber, as you can see, for the rest of April. Final decline May 1st. Final decline May 1st. And this is, of course, a monthly time frame chart. I can't catch, of course, I can catch that granularity with the daily chart. And yes, this looks all the way into June, but of course I have to squeeze it into available space so you understand the pattern that we're following. Wave 3 should be done pretty soon. Wave 4 and wave 5. Ideally, May 1st we should have done, and then a massive rally, okay? A massive rally would not surprise me if that is the case, even if it's just a B wave. Semiconductors, this is what we saw on Thursday, down, up, down. And we're right here in the third wave target zone. Nothing out of the ordinary yet for the semiconductors. So all the indexes will align, all right, with their third, fourth, and fifth wave. And you can see here we're looking for an ideal low at around 3220 plus or minus 20. We don't have to follow the ideal Fibonacci-based standard impulse pattern, but it is quite common. Once again, we had the 3, the 4, and then, of course, a low here earlier this week was plenty. All right, on Monday, we had done enough. The market could have decided to move higher already, that it was rally time, but it decided not to. That's very unfortunate. That's what happens, unfortunately, when price breaks below certain key levels, and that's why Monday's low had to hold. I think I've really brought that forward. We need to hold Monday's low so we can move higher. Well, the market decided not to hold Monday's low, and here we are, impulse lower, but also here you can see we're wrapping up this final chapter. And that should be a larger A wave of a cycle fourth wave, okay? So this is, of course, the entire cycle 3 wave. Cycle 2 was 2008. And again, somewhere around 3200, what was I looking for? 3200 should be a nice target zone. That's about the 50% retrace. That is this ideal wave C of 4 target zone, but that's only going to be A, and most of the time cycle 4 waves, or major 4, or primary 4, or minute 4, whatever, fourth waves are flats. Look here, this was a zigzag for wave 2. Most likely wave 4 will be a flat. Once again, we're in major buying zones for those that have an attention span longer than 1 minute. Also remember, we made a higher high on the MACD for the semiconductors. Similarly for the Dow Jones, we did make a higher high on the MACD, which does suggest we're also going to make a higher high on price, potentially with a lower high in the MACD. So no, I do not think this is the end of the world. I do not think this is the end of the stock market. I do think the semiconductors are in a cycle 4. I do think the industrials are in a different fourth wave, potentially just a B wave of a continuing bull market. And of course, if we get this B wave higher, that of course will drive other indexes higher as well. They're back aligned. All right. So this still looks very promising for the big picture. This is fantastic. I also know we're getting very close to the bottom because people are throwing their subscriptions into the wind as if that will change the market direction. Anyways, onto the IWM. Also, this one decided to subdivide. It didn't have to. On Monday, we had enough low in place to consider wave 5 of 5 done. Well, we're subdividing because 3 of not really reached its ideal target. Far, we're in the ideal 3 of 5 target zone. Bounce, drop, complete. So we're starting to look for a bounce, a drop, and completion of this decline. This is the big picture chart of the IWM. I have not shared this one with you in a long time, but nothing has really changed, and it looks like we have a fantastic upcoming buying opportunity on our hands for either a big bounce back for a cycle B wave or all of the completion of super cycle 4. Again, the small caps are in a different count than the other caps, all right? The large caps and the mid caps, or the semiconductors or the industrials. It's all different. 2020 was cycle 4, clear ABC lower. See this cycle 4 wave, kind of how it compares on a smaller time frame, what we've just seen here. And here we had similar time length from the top of cycle 3 in 2018 to 2020. All right, so about, I would say, a year and a couple of months. A year and a couple of months. So now we're in super cycle 4. It's either going to subdivide one more time in a larger ABC, so with the A wave about to complete. And you can see here the ideal bottoming zone is somewhere between 150 and I would say 167. All right, so here we go. Ideal bottoming zone here is at around 175. So that gets very close. Okay, then we have so far a irregular flat on our hands. The B wave made a new all-time high. And this is not a impulse. This is the 5 wave advance here that we've seen 1, 2, 3, 4, 5. And that's of a C wave, 1, 2, 3, 4, 5. And now either all of super cycle 4 is going to complete, or we're just going to get a bounce and then lower again. To be determined. I don't know yet. But I do know is that we're going to look here for 5 waves lower. And that will complete this C wave. Just that we had 5 wave lower in 2020. All right. So also this one is getting very close to a major buying opportunity. And these blue lines show you those buying opportunities when the RSI 5 on the monthly time frame got this crazy oversold. 2022, 2020, 2019, 2016, 2015, not so good. 2011, fantastic. 2009, fantastic. 2008, not so good. 2008 again, meh, not so good. And 2023, fantastic. So we have, of course, always a few that are not so good and a lot of fantastic ones. But every single time, the market definitely went higher. Was it either for 2 months or for 2+ years? So please keep that in mind where we are. That's the big picture. So now let's look at market breadth. I know it's a fantastically long webcast, but we got to cover everything. Finally, we have a move for the new lows above 1,000. It stayed below 250 for the longest of time, but we're still not yet in bear market territory, meaning a 2-month decline of at least 20%. Every single time we got that, you can see here 66, 70, 74, 82, 87, 90, 98, etc. We had fantastic long-term gains. Long-term gains being more than 1 minute, more than a month, almost more than a year. All right. Sometimes a little bit less, but oftentimes it's more than a year. That's just long-term. Every single time. Okay. So please keep that in mind. Bullish percent index. This is the bullish percent index for the S&P 500. Getting very close, and these are the occasions when it goes below 20. Also shows most of the time we're pretty close to a very good bottom. Not all the time, but often. How about the VIX? The VIX is at 45, my dear friends. That is crazy high. And these are all the cases since 1990 when it went above 45. 1, 2, 3, 4. A couple, of course, more in 2009. These ones, and all of them show we're getting awfully close to a bottom, much closer to a bottom than to a top. All right, there, and there, and there. All right, so this one we have to discard. I don't know why that line showed up. Okay, so once again, odds favor. We're getting very close to a bottom, which the Elliott wave count with the last 3, 4, and 5 aligns with well. I have a little bit less data for the VIX divided by the VXV, which is pretty much current volatility divided by long-term volatility. It's above 1.2, and also that since 2008 doesn't happen very often. It's just pretty much a handful of times. And again, also here, every single time it happens, we have very good short-term to long-term lows in place. Okay, getting very close. Once again, then the bottom is much closer than the top. Shorter term, the PMO is at the low of the range, and also here the new lows and the new highs indicator also suggests still in a downtrend, but getting pretty washed out as well. So that's what I have for you today. I hope you really appreciate it. We're looking for the wrapping up of these final third, fourth, and fifth waves to present the market with a much more significant low, ideally later this month. It would align very well with liquidity. It would align very well with trendline support. And then we can see if we're going to get a 3, 4, 5 of a much larger ending diagonal, if we're going to get only just a 5 of a little smaller diagonal, or indeed if the top is in place, which can be the case for example, the technology sector, which is probably more aligned with the semiconductors. However, again, for the Dow Jones and the S&P 500, it still appears that we need at least one wave higher to complete the rally that started in March 2020. But even a big fat bounce in the semiconductors and the Nasdaq 100 will, of course, help the S&P 500 and the Dow Jones. And last but not least, it also looks like the small caps are getting very close to a significant bottom and that we should see much higher prices. If liquidity is correct, it should start pumping May, June, July. Don't know yet how far because we cannot look that far into the future. And the technical indicators are getting extremely oversold, extremely ripe for a bounce. But these are conditions, not yet trade triggers. Though history tells us when things get this crazy oversold and this crazy negative, then we have to assume that a low is in place. The phone rings. I gotta bye.